Imagine walking through a Dutch neighborhood where you're surrounded by charming canals, scenic architecture, and iconic windmills. But behind closed doors, we find millions of families struggling to pay their bills. Despite having one of the highest GDPs per capita, nearly 1.2 million people live below the poverty line. So how is it that a country can be blessed with such economic success, yet also face so many challenges? It all ties back to a disease that has plagued the Dutch economy for decades, one that we consider to be the biggest problem with the Dutch economy. To fully understand the Dutch disease, we need to start from the beginning, by exploring how the Netherlands' unique geography shaped its economy and history. From a geographical perspective, the Netherlands has a total 13,141 square miles land area with a coastal line of about 280 miles along the North Sea. And when countries have big coastal lines, trade automatically becomes their biggest source for economy. From as early as the 15th century, the Dutch became leaders in maritime trade. Cities like Rotterdam and Amsterdam were thriving as commercial hubs, like the Port of Amsterdam, which in 2023 generated an annual revenue of around $190 million. According to the books written by Jan L. van Zanden and Charles Ralph Boxer, the Dutch merchant marine totaled approximately 568,000 tons, accounting for about 50% of Europe's shipping capacity. Today, the Port of Rotterdam ranks number 10 in the 50 biggest container ports in the world, which shows just how much of a role the Netherlands has in global trade. As wealth poured into the nation through trade, the Dutch began to diversify their economy. Profits from trade were reinvested into three major areas: agriculture, maritime trade and shipping, and finance. The Dutch invested in agricultural innovations since their geographical position in Europe gave them a favorable climate for diverse agricultural production. Techniques such as crop rotation and selective breeding were adopted from the early stages, which is why in 2023, the Dutch's agricultural exports to be valued at approximately 123.8 billion euros, making the Netherlands the second largest exporter of agricultural products by value globally after the United States. To improve maritime trade, a significant portion of revenue was allocated to shipbuilding, allowing the Netherlands to maintain one of the largest merchant fleets in the world. Innovations such as the Floyd ship design took place, which allowed twice the cargo capacity of contemporary ships while requiring a smaller crew. Other than trade investments, the government established financial institutions like the Amsterdam Stock Exchange in 1602 that allowed investments in various ventures beyond trade. By then, there was an infamous chartered trading company named Dutch East India Company, or VOC for short. And when this company issued shares to the public, it attracted over 1,000 investors, including more than 400 small shareholders from various societal levels, such as bakers and barbers. This provided citizens with opportunities for investment, which ultimately led to the fact that by the mid-17th century, the Netherlands had one of the highest standards of living in Europe. But the next 2 centuries were not so friendly. Around 1670, the Dutch economy experienced a downturn because of the politico-military upheavals, including wars with France and England. The industrial sector faced dismantling and trade growth leveled off. By 1815, after the Napoleonic Wars, the newly independent Kingdom of the Netherlands confronted a largely deindustrialized economy burdened by a crippling public debt of 1.4 billion guilders. In the early 19th century, the economy faced stagnation due to a lack of investment and declining industrial competitiveness. Unemployment rates hovered around 3.5%, which limited growth in productivity. And then, of course, came the Great Depression, which had severe effects on the whole world, let alone the Dutch economy. Unemployment rose sharply, reaching about 20% by 1933, and after World War II, the Netherlands struggled to regain its economic footing. The economy grew slowly, with GDP growth averaging around 2% annually during the 1950s. This was a point of depression and stagnation for the Dutch economy, as there was no new innovations coming in, But then, there came a miracle. In 1959, a significant turning point arrived when vast reserves of natural gas were discovered in Groningen. At the time of discovery, the Groningen gas field was estimated to contain approximately 2,900 billion cubic meters of recoverable natural gas and was projected to sustain production until the year 2080. With such incredible numbers, the exploitation of these gas reserves began to generate substantial revenue for the Dutch government. By the early 1970s, revenues from natural gas accounted for approximately 5% of GDP. The government used revenues from natural gas to invest in infrastructure, education, and technology. Even public investments surged between 1960 and 1970, which led to a percentage increase in GDP from 17% to about 25%. By 1973, real GDP per capita had risen substantially, which led to improved living standards and economic health. The natural gas sector created numerous jobs directly and indirectly through related industries such as construction and manufacturing. Unemployment rates had dropped to around 1.5%. The Dutch economy revived itself with this newfound gas reserve, and they used it to fuel every other sector which needed a revival. However, as the country enjoyed the wealth pouring in from natural gas, it began to rely on it a little too much, believing that this one resource could fuel its entire future. At the time, future investments began to flow predominantly into oil and gas extraction, with hopes that the economy could become entirely reliant on these resources. This included building pipelines and enhancing processing facilities. As a result, by 1973, natural gas accounted for about 75% of total energy consumption in the Netherlands. Even though natural gas was the biggest cash cow of the economy, there were other sectors that also contributed to the Dutch economy, but when it comes to their fair share of wealth, they were overlooked. For example, the manufacturing sector contributed about 25% to GDP in the 1950s before the discovery of natural gas. It fell to 15% in the early 1970s. The appreciation of the Dutch guilder due to natural gas revenues made Dutch manufactured goods less competitive internationally, which is why unemployment in manufacturing rose from 1.1% in 1960 to 5.1% by 1977, as jobs shifted away from this sector. Agriculture accounted for about 7% of GDP in the late 1950s, with strong exports in dairy, flowers, and vegetables. However, by the mid-1980s, agricultural output stagnated, and its contribution to GDP fell to around 3% as labor and resources were redirected towards the booming gas sector. A similar downfall came in trade volumes due to higher costs associated with the appreciating currency. The real exchange rate appreciated significantly, making imports cheaper but exports more expensive. This neglect cost the economy a lot, as it led to higher employment rates, currency appreciation, and investment shifts. This also made the economy vulnerable to fluctuations, which was the case during the oil crisis of 1979. When energy prices fell or production faced challenges like environmental regulations, it exposed weaknesses in other sectors that had been neglected. Interestingly enough, this was something that was foresighted in 1977 in an article by The Economist, where they labeled this over-reliance of oil and negligence of other sectors. It was called the Dutch disease.
What you have is economies that are skewed towards supporting that sector, and then suddenly have to realize that if market forces move against them in terms of their revenues, the prices, what other sectors can they fall back on? And diversification is absolutely key.
In the Economist article, they highlighted the guilder's loss of competitiveness and described labor costs as a percentage of wages in manufacturing industries against 5 countries. This Dutch disease left other sectors underdeveloped and weakened. By the late 20th century and into the 21st century, concerns about sustainability and environmental impact grew. While production from natural gas fields started to decline due to regulatory measures, it was the increased seismic activity due to extraction that led to public outcry and damage claims that numbered over 250,000 by 2023. It came to a point that there was no hope left for the Groningen gas field. and so it needed to be shut down.
And finally, for business, the Netherlands announced on Sunday that it is halting extraction at the Groningen gas field, that is Europe's largest. Discovered in 1959, the field originally contained some 2.8 billion cubic meters of gas. 2.3 billion of that has already been extracted by the energy firms Shell and Esso. Those operations generated around 430 billion euros for the Dutch state. They also, though, created a disaster for residents of the Groningen region. For some 2 decades, locals have complained of earthquakes attributed to vacuum pockets created by the gas extraction, tremors which have caused widespread severe damage to homes and other buildings. Residents thus relieved by the shutdown, though experts warn that those earthquakes could continue for years, and it's something...
The aftermath of the Dutch disease further intensified as the COVID-19 pandemic came. When the Dutch economy contracted by 4.1% in 2020, marking one of the largest downturns since World War II. In the first 2 quarters of 2020, economic activity shrank by 1.5% and 8.5% quarter-on-quarter, respectively. Unemployment rose from a record low of 2.9% in early 2020 to approximately 4.5% by the end of that year. In response to these ongoing challenges, particularly exacerbated by crises such as the COVID-19 pandemic, the Dutch government launched the Recovery and Resilience Plan in 2021. The plan included investments in green technologies and digital transformation with a commitment of over $3 billion towards sustainability initiatives. The Dutch government provided extensive financial support amounting to 3.6% of GDP. This included wage subsidies and direct financial assistance for affected sectors. Recently, the Dutch economy has slowed down as inflation affected private consumption and the weak external environment held back exports. According to the economic forecast for the Netherlands, growth is forecast to pick up to 0.8%, thanks to an increase in real wage growth and an expansion in government consumption and public investment. However, business investment is still expected to remain weak. Growth is expected to continue its upward trend in 2025. Reaching 1.5%, driven by strong private consumption and a more positive outlook for business investment and trade. However, the government deficit is anticipated to rise over the forecast period, reaching 2.1% of GDP by 2025. Meanwhile, government debt is projected to stay relatively stable, with an expected level of 46.8% of GDP in 2025. And there you have it. The rise, fall, and quite possibly the revival of the Dutch economy. From its history of trade dominance to the challenges brought on by over-reliance on natural gas, the Netherlands has weathered centuries of economic shifts. But now, with inflation and a growing wealth gap, we have to wonder, is the Dutch economy really recovering, or are deeper issues still holding it back? We'd love to hear your thoughts on this, so be sure to drop your thoughts in the comments below. See you in the next one.